Great, thank you, Vishal. Yeah, so today's topic obviously is about private credit, and we will provide you with a one-on-one session on private credit with the expertise from Carlyle. And before we get into the main content, I have a few compliance slides to show for Singapore, Hong Kong, and for Carlyle as well. So I'll give a quick introduction to those who are not very familiar with who Endowus is. Essentially, we are very missional about what we do. So our core mission really is to empower individuals and families to thrive and to achieve their goals through quality advice and access delivered at low fair cost, so that everyone can invest better to live better. We are mostly employee-owned, but also with very strong external backings. Some of our external investors include the likes of UBS, EDBI, Prosus, who is the largest shareholder of Tencent, Singtel, Samsung, and etc. And at our core, we are a digital wealth management platform that tries to solve all the pain points of investing through traditional distribution wealth channels. And the key is that we are truly independent and conflict-free. We are agnostic to fund managers, and we just want to bring their best products to our clients at the lowest cost possible with the best possible advice, so that our clients can reach their wealth goals. We are the first digital platform for both your private wealth and public pension. In Singapore, we are the first digital advisor for the pension scheme, CPF, and we hope to bring this to the Hong Kong MPF in the future as well. And as you probably already know, if you are here with us at this live session, we are very missional about financial education and literacy. So we host a fast kind of variety of content on both our insights page, which can be accessed through our website, as well as on our YouTube page, which is available to you through the forms of live webinars, which most of which are also available afterwards on the YouTube channel. And we have started a series to kind of make private markets education accessible for everyone. So we have done a few sessions with UBS, and we have done one on global macro strategies with Wellington. And today we are here to discuss private credit strategies with Carlyle. And if you would like to check out other content that we have done in the past, please feel free to go to our YouTube channel and check it out. And today we also have a live Q&A session in the end. So please feel free to post all of your questions through this Slido link, and we will spare some time at the end to go through the questions together. Great. So before we dive into this asset class, very fascinating asset class, private credit, I would like Vishal to quickly introduce the Carlyle Group and himself.
Sure. So, just starting with a quick introduction of Carlyle and who we are. The firm was founded in 1987, and today we manage about $380 billion of assets across three main segments: private equity, which was really where the business began, but also today global credit and investment solutions, of which global credit is $150 billion. And private credit, that we're going to talk about in more detail, is a subsegment of global credit at Carlyle. And it's certainly one of our more important and fast-growing strategies that we have. One of the other things I'll highlight is we have 750 investment professionals around the globe across 17 offices. And with that, with our history, with our AUM, we certainly developed what we think is a distinct edge when we think about the network we have. We call it the One Carlyle Network, the industry knowledge we've developed, and portfolio data that we have across all the companies we know and we interact with. And we try and bring all those capabilities and all that knowledge to each investment we do in private credit. And that's just something, I wanted to mention up front as we kind of talk about the asset class and we talk about what's going on in the asset class. And then a little bit more background on me. So as I mentioned, I'm a product specialist focusing on private credit. I'm based in New York. I joined Carlyle about 2 years ago. Before that, I spent some time at PIMCO in Newport Beach, California, also focusing on private credit strategies. So, personally, it's been really interesting to see just this evolution and this growth of this asset class. And I'm happy to talk about that with you all today.
Great, thank you. And I think maybe many of the audience don't know that you're dialing in from your midnight. So yeah, a lot of appreciation for that. And I hope you enjoyed this session as well. All right, okay, so before I give the spotlight to Vishal and let him talk all about private credit, which is what he's passionate about, I'll just give a brief introduction to what this asset class is. And a quick caveat is that private credit is a very broad asset class with a diverse strategy array of strategies. So in this introduction, the performance and risk data will primarily be focused on the biggest part of private credit, which is direct lending to middle market companies. So what is private credit? At its core, essentially private credit are the loans and bonds for companies provided by non-bank lender. Imagine if a company would like to take out a loan for its own business. There are a few ways to go. For smaller companies, they can go to a commercial bank and take out a bank loan. For bigger companies, they could tap into the public market and issue corporate bonds. So private credit is essentially another form or an alternative form of debt financing. Instead of going to a bank or to the public, companies can go to a private credit provider, such as Carlyle, and borrow from them. So who would use private credit? Traditionally, it tends to be the SMEs, the small and medium enterprises, but there have been more and more large cap companies also choosing private credit over public debt markets. And this trend speaks to two things. First, the retreat of traditional lenders like banks. And second, the advantage of private credit. For example, lenders and borrowers, they can negotiate more flexible and customized terms. There is more certainty and efficiency of execution. And for us investors, private credit presents an alternative investment opportunity. However, it also carries its own risk. It is much less liquid than public corporate debt. And as with all company debt, it carries credit default risk in the event that the company could not afford to pay back the debt. I personally find it extremely useful to understand the history of private credit market, and I would like to share that with you as well. So private lending already had its early roots in the late 20th century. It was to really meet the financing needs of middle market businesses and those with limited access to capital markets. And then the rise of leveraged buyouts in the 1980s really got this asset class going. So when a private equity firm acquires a company, it generally requires the use of a combination of debt and equity financing. And that debt financing component often comes from private credit source. And this tie-up between private equity and private credit company is still pretty prevalent today in one way or another. And I believe you have heard Vishal in his brief introduction of Carlyle. Carlyle actually started as a private equity firm. And this has kind of lent itself into a unique position in private credit market as well. And then the global financial crisis further changed the shape of the financing market. So banks became more cautious in their lending practice, and there was an increasing funding gap between what companies actually need and what banks could provide. So private credit providers stepped in and they saw the opportunity to fill the gap. And in the past decade, the low interest rate environment, coupled with investors' quest for higher yields, further contributed to the increasing popularity of private credit as an asset class. So from what I have mentioned so far, I believe some investors would have already picked up a few compelling reasons to explore this asset class further. For example, maybe it offers potential diversification to the public market. It seems that the companies that take out private loans are of a different profile to those that will go to the public markets. Or maybe it offers higher return because investors must be compensated in one way or another for the illiquidity that they take. So why don't we look at some numbers quickly and consider the question of why one should consider and allocate to private credit. Firstly, it is true that private credit tends to have a yield pickup compared to public credit. So this chart compares the historical yield to maturity of private direct lending with public high yield market and leveraged loan market. And the data suggests that private direct lending has consistently had a high yield to its public comparison. And by the end of March 2023, we saw a yield above 11% in private direct lending, while that of high yield and leveraged loan markets was below 10%. And how did this translate into historical return? This table compares the calendar year performance of direct lending to high yield, leveraged loan, and global ag for the past 18 years. The blue box highlights the best performing asset class for each calendar year. And not surprisingly, the direct lending market has dominated the performance for most years. Another interesting thing to see from this chart is that the red box highlights the years where most markets experienced drawdowns. For example, during 2008, the global financial crisis, and during 2022, where interest rate environment changed drastically. But if we compare the performance of direct lending to the public markets in those years, we saw amazing downside resilience. And there's obviously fundamental reasons for that as well. For example, the credit loss ratio for direct lending segment has historically been lower than that of the high yield market. So just by looking at historical data, private credit might offer investors a good option to enhance return and downside protection. And to tie everything up, what it means in the portfolio context is that adding private credit to one's overall portfolio could help to improve the risk-adjusted return of the portfolio. And the chart plots the risk and return of a few asset allocations. So let's focus on the top left and the bottom right pie charts. Imagine the starting point of an investor is completely public market with 40% in public fixed income and 60% in equities. And within that 40% of public fixed income, the investors decided to take on a little bit of higher risk. So he allocated 10% to high yield and bank loans. And if that investor just replaced that 20% of allocation to high yield and bank loans with private credit, this allocation is represented by the top left pie chart. The risk return profile of the overall portfolio for this investor would have been improved meaningfully. And this is the power of adding an attractive diversifying asset class to one's portfolio. So that was a very quick introduction. And now I am going to turn the spotlight to our expert here, Vishal, for a deeper dive into the asset class. I'm going to do a Q&A format to keep everyone kind of engaged and keep the conversation interesting. So my first question for you, Vishal, is, firstly, you will know it very well that the umbrella name private credit covers a range of strategies, right? People might pick up terms like direct lending, and I was talking about it just now. There's also opportunistic credit, there's also special situations, but it's very difficult without experts' explanation, like what's the differences between them. So can you help us to lay a foundation for our understanding of the different strategies in private credit?
Sure, and if we go to the next slide, I think a lot of what we'll try and do today is illustrate some of the points that, Yulin, you already mentioned about why it's attractive and how we should think about this space. So, high level, one of the things I think to remember about private credit is it's really a segment of the fixed income market, which has really evolved. And if we look at traditional fixed income, we think of government issued debt, we think of corporate debt that's investment grade, municipal bonds. It's really similar to that, but just a different segment of what we call alternative credit, what we call private credit, what is basically, a similar yielding strategy that exists in the broader fixed income market. And, one of the differences with credit versus equity is credit has a lot of different types. Equity tends to be a little more simpler. It's at the bottom of the capital stack. So, that also probably leads to more questions on what exactly is private credit. But again, the simplest way to think of it is really just this being a subset of traditional fixed income, but with one key commonality, I would say, within, in all the types, that these are basically not liquid, not tradable loans. So it's really hard for the everyday investor to come across these, but it is certainly something that, at Carlyle, we've been active in, and it's certainly a bigger and growing part of the broader fixed income market. Maybe, moving to the next slide, and just to kind of illustrate what this means and how this may have changed in some characteristics. If we think of what the banks did and what they still do to this day, but to a lesser extent, private credit is basically, in a way, doing something very similar. It is financing across the capital structure, senior, junior, as well as preferred equity to an extent, capital for borrowers. This can be small and medium enterprises. This can certainly be larger borrowers. It can really be, any borrower that would otherwise go to a bank that could today access the private credit market for capital. So it's, one thing is important to remember, private credit doesn't necessarily mean junior or riskier. It's really more a factor of the less liquid or illiquid nature of that investment. Other characteristics that I think are also important to highlight: private credit typically tends to involve bespoke structures, and they're privately non-bank originated. So these are typically originated outside of what you would think of a traditional intermediary bank channel. Hold sizes tend to be larger because there are fewer participants. And there's also bilateral or direct negotiations and therefore better control of terms on these deals. So, certain characteristics besides illiquidity that also define the market to an extent, but really the key is, this is a subsegment of fixed income, except that it's predominantly not liquid.
Great, thanks, Vishal. That was really helpful. I think it's good to kind of be clear on the point that private credit financing can actually range from different, from lower capital stack to senior secured capital stack, which is probably even of a better recovery profile, credit profile than high yield market. But liquidity really is one of the key concerns or key consideration for investors here. Can you just touch upon for us how the risk and return profile of private credit then compared to other investment options?
Sure. And, we'll talk about risk here, not just in terms of structural risk, but also diversification, because I think that's an important point that sometimes people miss. So when we look at private credit, and if we look at all the different asset classes, if we go to the next slide, you can really see a range of return potential. And this is because, again, as we talked about before, private credit doesn't necessarily mean senior, junior. It's more about the illiquid and less, more bespoke nature of each investment. So senior debt, if we think about that as the most vanilla form of private credit, tends to be the most range bound. You have opportunistic and special situations, which is the lower you go in capital structure, the higher the potential yield is. But then you also have, it's less prominent, but it's certainly important, other segments within private credit that are, similar to senior corporate credit, but that are very important and different from a diversification standpoint. So when we think of our overall portfolios and correlations, there's not just this potential for better yield in private credit. There's also this potential for diversification, and there's, more ways to access this diversification in private credit than there would be if you were to just access public credit or even equity markets to that extent. When we think of royalties, for example, music royalties, the correlation there with the broader economy is arguably much lower than what you may see in high yield or even investment grade bonds. And that's an important consideration, not just the yield.
Yeah, that's very, very interesting. And it's fascinating to think about private credit to cover very interesting assets such as music royalties. You wouldn't imagine as an investor this would become something that is investable and kind of a standalone sub asset class by itself. Since this is such a vast and complex kind of field, and we know that Carlyle specializes in this. So how do private credit managers add value in this space? And what role does due diligence play in private credit?
Yeah, it's an extremely important question, one that we get asked all the time as well. And it's a fair question. I would say manager selection is extremely important because you have this directly originated nature of each investment. So with bespoke structures, with custom solutions, it becomes all the more important to ensure you get that right in order to make sure that the investment is, profitable for you and it's not a losing case at the end of the day. It's also, ultimately on the manager to source, underwrite, and manage that investment. So really having control of the entire funnel from the beginning of the investment till it ultimately matures. So again, it's extremely important and it's a big consideration. One of the things here that I'll flag is also being able to have managers who have experience that can manage investments through different cycles. We've certainly seen the impact of COVID in 2020. We saw volatility back in 2008. We've seen, shorter but similar shocks in periods in between 2008 and 2020. So being able to understand what kind of a scenario an investment may go through and navigate through that is an important consideration. And, this slide right here, it's effectively what it's trying to illustrate is you have this risk today of fatter tails, and there's tail event risks that can happen. We never know how they can happen. COVID was a great example, but these tail risks have, this potential to have very massive impacts on your portfolio. And these tail events, the impact has only, effectively grown in recent years. So it's something that we watch very carefully for at Carlyle, that we try and manage, because it's something that we don't think is going to go away anytime soon. And, similarly on the next page, you also have this growing dispersion between regions and sectors, different issuers within sectors that you don't necessarily see when you invest in public markets or indices, but that's certainly much more prominent in private markets. So again, having that through cycle experience, having the ability to bring a level of expertise and knowledge to the companies, which sometimes are family owned or, small business enterprises, to help them navigate that as Carlyle, is really important. And then lastly, just being active in the space for a long time, having seen, different areas, it's certainly private credit as a whole and private credit managers, experience and time and first mover advantage certainly becomes more and more important. And, this is a good slide here just to kind of talk a little bit about also how investor preferences have sort of played into the mix. If you think about banks and how they were the primary provider of liquidity, today a lot of investors look at private credit managers and invest with private credit managers to effectively fill that void. So, being able to look at how the market was back in 2008, being able to see how that's evolved, and then also, benefiting from some of that talent migration. So, having the in-house resources to manage some of those investments becomes all the more important.
Yeah, that's a very good point. So I think I have kind of shared from my perspective, from an asset allocator's perspective, why private credit might be an interesting thing for investors' overall portfolio, but also there's risk. But from your perspective as an asset manager, as someone who sees the deal flow every day, what are the main advantages and disadvantages of investing in private credit? What are some of the key things that people should probably think about as they think about this asset class?
Yeah, and taking a step back also, because private equity is, I think, a very good example of an asset class that is similar in a way that it kind of is in fairly new asset class. It's one that has, performed fairly well through cycles. Private credit in many ways is similar. And it also, I think, has, ridden the wave of private equity growth. But private credit in every way is more senior to equity. So when we think of, private credit and the advantage, there is always, when you think of credit versus equity and private credit versus private equity, an implicit seniority in the investments that you do. But at the same time, you do get higher yields for these investments that comes from that illiquidity, rather than this risk that comes from, call it higher credit risk or lower capital structure risk. And it's, an important point because the trade-off to that is the lack of liquidity is certainly something investors should consider. Private credit is really, not an easy asset class to get liquidity in. When liquidity is available, it certainly comes at a price. So most investors, when we talk about private credit, understand there needs to be a bit of a long-term outlook, just like there is with private equity. But, there's more yield. There's the diversification aspect as well. There's multiple ways to access private credit besides just being at the lowest point of the capital structure. All those we think certainly outweigh the disadvantage of liquidity, especially if investors have a longer time horizon to invest and to remain invested.
Yeah, and actually just since you were mentioning about the liquidity profile between private credit and private equity, another point that maybe I wanted to throw back to you to see whether you agree is a big distinction between private credit and private equity is the path to liquidity for private equity can be a little bit uncertain. It could be dependent on an IPO in the end, or the company being bought out by another investor. However, when it comes to private credit, it's a little bit different because you are kind of collecting that interest on a regular basis. And you know how long this debt is going to be. And if the company is in good shape, the company will pay you back.
That's right. And there's also shorter terms, I would say, for private credit loans versus what would be a typical hold period for a private equity investment. So if we think of a standard private credit corporate loan, most cases you're lending the money out for maybe 5 or 6 or 7 years, after which you're going to get paid all that capital back, and you're also going to collect interest in that interim period. So when you think of your weighted average life of that loan, it tends to be much shorter than private equity, which really doesn't have an income component to it. So once you invest, there's really no cash coming in. And there's also the fact that you get your money only when there's an IPO or when there's a full turnaround, which can typically take 10 or even 15 years in some cases. So there's a shorter life to private credit. There's a yield component, so you start getting paid almost immediately in private credit. And then there's also that diversification benefit that comes with it at the same time.
Yeah, definitely. And maybe we can talk a little bit more about kind of the BDC structure and the semi-liquid vehicle a bit later. Because actually, I think with this innovative structure, there is improved liquidity profile for the end investors as well. But before we go there, I just wanted to pick your brain on the outlook for private credit. And I think we have actually received a few questions relating to this as well. I saw people asking about emerging trends in private credits, key trends that you have seen in private credit in the past 1 to 3 years, for example, and how this has impacted your deal flow at Carlyle Group. And also what's the main theme for private credit this year? It might be a bit short term, but if you have anything to share with us on that front, it will be interesting to hear as well.
Sure. And worst case, remind me at the end if I don't come to those. But I'll kind of start a little bit with the outlook, and hopefully this will also cover a little bit about what we're excited about. But in general, I would say that we think this is an extremely attractive time for private credit. And it's funny because, this asset class saw tremendous growth post 2008. It's kind of, probably picked up some of that growth in 2016. The onset of COVID, charged it a little bit. And then earlier this year, you also had, some of the bank volatility. You had the Silicon Valley Bank, receivership happen, which again led to some retrenchment of regional banks, where again small and medium enterprise businesses typically go to capital. Suddenly some of those supply lines were starting to get shut off. So there's this, there's a combination of this secular trend of growth we've seen, but that's also seen these periodic pockets of quicker growth that's really made today's environment very meaningfully attractive. There's also the fact that the Fed has been raising rates with base rates where they are today, given the floating rate nature of the loans that we originate. You're also seeing higher yields than you used to see maybe 2 or 3 years ago. And this is certainly not in, the higher base rates don't evenly impact every aspect of credit markets, but they've certainly impacted in a positive way private credit markets quite significantly. And then there's the ongoing bank pressures. And then there's lastly this element of growth in private equity as well. And in many ways, private equity, and you can see this on the chart on the right, private equity growth tends to be a bit of a barometer for private credit because private equity companies raise capital, they have transactions, they typically work with private credit managers on the financing. So as we see this secular trend in the bank retrenchment as well as the growth, you kind of see both the supply shrinking as well as the demand increasing. That's really the void that private credit has started to fill. And that's the void that makes us feel pretty good about being price makers rather than price takers. But at the same time, I think there's an important consideration, which is, and this is when we think about the outlook, is it can certainly change once again. And if we go to the next slide, this is looking back just a few years. You had 2019, which was sort of a late cycle economic environment. You had the onset of COVID. You had that recovery and increasing, sort of tepid, growth that was coming back. And then 2022, this really post-COVID economic environment coming to the surface. And within that, opportunities across different aspects of private credit have changed. They've gone, whether it's direct lending, whether it's asset-based, whether it's certain opportunistic, it's certainly shifted. And, accordingly, I think part of it for us is being prepared for 2023, being ready that, whether you can have a bit of a more flexible or tactical approach, that's certainly something we try and keep in mind, seeing what's happened in the past. And it's something that I think is fair to expect when we look at coming years ahead. And then lastly, on the next slide, there are certain, philosophies or characteristics we try and follow that we think really can help us navigate all different kinds of cycles. It's hard to do that perfectly, but in general, if we are able to build diverse portfolios, we keep our portfolios defensive, we make sure that every structure is bespoke and custom for that specific borrower. We really, utilize our private credit origination edge. And, finally, our scale of capital. We think all those capabilities really give us a way to invest across cycles. And that's really an important point. And I think it kind of ties back to one of the, the first things I mentioned, which is at Carlyle, we try and bring all our capabilities in private markets, whether it's across private equity as well as global credit more broadly, to every single transaction we do in private credit. And, that's certainly what we think is a big differentiator and hopefully an edge over time.
Yeah, great. This is very helpful. And I have a follow-on question, actually going back to your previous slide. Let me just try to go back before we go to Q&A with the audience. So this chart ends at 2022, and we know that 2022 was just dominated by interest rate kind of risk and headlines. And as we just wrapped up the first half of 2023, and not surprisingly, the top stories for the investment universe continues to be inflation and interest rates. So how has that impacted the investment environment for private credit so far this year?
Yeah, it's been an eventful year. That's one way to put it. But I think if you just kind of look at the Fed actions in 2022 and year-to-date 2023, they've raised rates by almost 5% from where they were. And in some ways, that's had a bit of an unintended consequence of certain bank failures, the Silicon Valley Bank that I mentioned. And, that's really led to this sort of pullback in regional markets. And that's honestly been a good thing for private credit. It's been a place where we've been able to step in and take advantage. So going beyond your traditional sponsor-backed, lending base to also include potentially family-owned and entrepreneurial owned companies that also have, capital requirements, but that aren't able to get that capital as easily because there's been this bit of a knock-on effect from what the Fed did to the banks. And, in this kind of a market, with base rates where they are, with the ability of us being able to look at where yields are, we feel very good in staying relatively at the top of the capital structure. So when you have 10% plus returns from being senior secured in the capital stack, it's certainly, we feel pretty good about being there. And it almost sometimes makes you wonder at what level is the equity going to have to return in order for that to be attractive when you're getting 10% at the top. So I think that's really been a theme of 2023, but it's also something that, we think is in ways going to continue. And it's also, relatedly, I think you're starting to see similar pockets of opportunity like that outside of direct lending, but also in real assets and in the liquid loan market.
Yeah. Okay. I see a lot of questions from the audience. This is surprisingly a very, I think people generally have quite good understanding on private credit and they're asking really good questions. So that's great. And just to continue, now the top voted question is actually on interest rate. I think we've opened a can of worms here, but maybe can you touch upon on how does the interest rate impact the returns of private credit? You mentioned it's pretty much floating rate. So yeah, is higher interest rate better for private credit?
Yeah, so the simple answer is higher rates are generally good for private credit. But there is this important consideration that at a certain point, if interest rates go too high, your borrowers that typically have a fixed cash flow, they're going to start to have difficulty making payments. And that can sometimes lead to defaults. It can lead to other issues with payments. It can ultimately also lead to lower returns. So one thing that we monitor very carefully at Carlyle is at what level are interest rates today? What does that mean for borrowers in terms of their interest coverage, or basically their cash flow percentage that's, being required to service the debt? And also, at what level do rates have to be where there's actually stresses starting to percolate into the portfolio? So where we see current rates today and where we also see current rates going as what's priced by the market, we generally feel pretty good about our borrowers and their ability to make payments. So you could say, yes, higher interest rates are good. But one thing that in general we watch out for, and I think it's an important, consideration for all private credit managers, is at a certain level, higher interest rates aren't necessarily beneficial. It really depends, though, what level that is. That really depends on which manager and how they're looking at their portfolios.
Yeah, definitely. There's a few more questions on performance. So I'll try to group them together and summarize. But just, I think the most imminently related question is, how should we think of the expected returns of private credit strategies today? What is the expected range? It might be a bit hard to give kind of a blanket answer. And what is the max downside? Can you just give us a sense of that if it's possible?
Sure, and I think a simple way to do it is let's kind of break out the components a little bit and walk through them and see where we end up. So we look at base rates today. It's about 5.25%. So let's assume 5% for simplicity. If we look at a vanilla corporate loan, you could typically assume a spread of anywhere from 500 to 700 basis points. So that's 5 to 7% on top of it. So, we take the median of that, which is about 6%, and you take base rates of about 5%, you're already at a 10% plus yield for a first lien senior secured private credit directly originated loan. Typically, there's also, OID and there's other elements of return which could potentially enhance that a little bit more. But I think a simple ballpark is to think of it as roughly in excess of 10%, which if you look back to just 3 or 4 years ago is extremely attractive, because 3 or 4 years ago, when rates were close to zero, your base rate was effectively set at 1%, which was the floor that you typically negotiated. So 1% plus your spread was typically only 6 or 7% at most. Today, that's in excess of 10%. Now, the consideration on the losses is you could probably expect slightly higher defaults, but at the same time, you would think that the 3-4% in extra yield is going to more than make up for it. That's the simple way I would say to think about where we are today in terms of returns.
Yeah, that's a good way to break it down for investors. And I guess when it comes to different strategies within private credit, there's also a range. And what you have given is really the kind of the most senior first lien part of private credit.
That's right.
Yeah. Another question, it's I guess because private credit market, it's not really mark to market because of its illiquidity and all these. People are wondering whether the recent outperformance of private credit is driven by this accounting method rather than better performance. Can you demystify this for us a little bit?
Sure. It's a fair question, but I think, there is certainly, while it's not fully mark to market, there is an element of market, inputs that are typically taken into account for valuations. But part of it is because of the bespoke nature of the transactions, because of the metrics that we're tracking, we're typically utilizing those inputs in addition to the market inputs to value those assets. I wouldn't say that that's the reason for outperformance. I mean, if you look back in 2020 during COVID, certainly most private credit managers were pretty aggressive in marking down their books, in line with the broader market, even though at the time there wasn't necessarily signs of portfolio stress. And we saw that because post-COVID, there wasn't really a pickup in defaults, but you rather just saw this gradual improvement as most companies recovered out of that trough. So, I would say the higher returns that investors may be seeing is more likely an element of the higher income rather than, lower or higher than expected marks versus public market equivalents.
Yeah, and would you say the divergence of performance in 2022 between high yield market and the private credit market, direct lending space, is partly because private credit market was mostly floating rate, whereas high yield is fixed rate, and there is obviously this mark-to-market impact that's bigger on high yield market?
Absolutely. And what happened with high yield markets was, especially when it relates to interest rates and base rates going higher, was it impacted the duration of high yield rather than the credit risk. So part of the repricing in high yield markets, which didn't carry on into private credit markets, was because of that fixed rate nature of high yield. That's typically the case versus private credit that's predominantly floating rate related.
Yeah, exactly. Continuing on this topic, what will happen if the rate starts to go lower? What would you see? I don't know, how would it impact your NAV, your income, your return?
Sure. So I think the most immediate impact would certainly be on the income element. These are floating rate loans, So you would expect to see if base rates go down, there's an expectation that income would be reduced as well. But one thing I would caveat is most private credit transactions, and something we try to do at Carlyle is structure transactions with what we call base rate floors. So if base rates go below a certain level, the floor effectively determines the rate that you're going to be paying, not necessarily the base rate level itself. So let's say you set a floor of 1% or 2%. If base rates continue to go lower and they go below 1% or 2%, we would still get paid the floor plus our spread on the investments. So that's one of the mitigants that managers use, especially in private credit, to protect against base rates going lower.
Yeah, for sure. Okay, I think we've covered quite a lot on interest rates. And let's switch gear a little bit to something more interesting. There's one question on royalties. I think someone's quite fascinated by that and wants to hear a real example of some of the underlying credit funding sources for royalties and how it works.
Sure. So without going into too much detail, I would say think of royalties and music royalties as an uncorrelated return stream. So as music artists, music portfolios are effectively sold or owned such that the income that comes from streaming music or just from the music rights versus going to the artist is effectively going to a private credit manager. And there's typically a transaction whereby that is sold at what's considered the fair value today of the future cash flow streams. So tends to be a little more complex. It's not a corporate credit deal, so there's different considerations to take into account. But it's also very different in terms of the underwriting and what you have to look at in terms of the risks and considerations. So, those kinds of transactions really encompass what we call royalties. It doesn't just have to be music. There's also other types of art and such that can constitute it. But the big benefit that you get is a really uncorrelated return stream versus something that may be impacted by broader economic trends. And it's certainly a growing part of the private credit market, something that you don't typically see in traditional or public fixed income.
Yeah. And let's go to other parts of private credit as well. There is a question on how do you see the infrastructure space now, as well as geographical allocations in Asia, Australia. Any thoughts on that?
Sure. So infrastructure is, it's certainly something we focus on at Carlyle. It's an important sector in that you typically have, it's what we call real assets backed private credit, where the actual collateral is typically the infrastructure itself, whether it's pipelines, whether it's plants or some other type of building. So in many cases, you're underwriting to that collateral versus the broader, cash flows of the company that you may typically see in a corporate credit deal. So that's really, something that we've seen and we've been pretty active in at Carlyle. As it relates to non-US investments, I think it's, certainly Europe in many ways, as we've seen private credit, the trends in the US, we're seeing Europe in many ways have similar trends, except, there's minor differences that really, come into account when you look at regional differences. So Europe and Asia really, I think, in some ways, following what we've seen in the US market more broadly, but, probably a few years behind. So that's kind of, I would say, the general picture of how those markets are. It's certainly not as developed, but they are developing.
Yeah, definitely. Another question that I have is, someone asked this question. It's a fair question, and that is, how would you assess credit risk better than banks?
It's a fair question, I will say. So one part of it is, I think it's important. It's not that banks don't want to do these deals because they're not attractive. Many times banks are constrained by regulatory issues that they may have, capital charges, just again, in general, when we look at Silicon Valley Bank and just some of the fallout, when we look at deposits, when we look at their source of capital, it's not as, as easy for them to make such investments. So it's certainly not, I think about them not wanting to do deals as much as us having this ability to do these deals really without the banks more and more so. And the other point I'll note is there's also this, I think we touched on it on one of the slides, but post 08 and with some of the regulation, there's also been a bit of a talent migration from banks to private credit managers. So really, some of the people who did this for banks today work at private credit managers like Carlyle. And we are now, instead of working through a bank with a middleman on structuring a bespoke deal or a solution, we're typically just bypassing the bank and working with the borrower directly. So it's certainly less about not working with. It's less about the banks not wanting to do the deal. It's more about them being a little more constrained in terms of what they can and can't do post 08.
Yeah, that's really fair. And and I think it's also kind of companies' preference as well in terms of going with banks and private credit companies. As you mentioned, there's just potentially more customization that can be done.
Yeah.
And it can be faster as well in terms of speed and execution.
And we've been a private equity manager, since 1987. So, we bring some of those capabilities many times when we're underwriting investments, especially when we look at, tail risks. We are underwriting such that we could potentially own the company. It's not ideal, but that's certainly an element of underwriting that I think is important because it gives you an edge when we think of private equity style diligence and bringing that to credit.
Yeah, that's a good point. I want to quickly touch upon access. We talked so much about this asset class, but how do investors access this asset class? I think there are a few ways, and we know there's closed-ended structures, where the capital will be locked up for a couple of years while you can, in the interim, receive distributions in terms of income. But there has been innovation in the past few years as well on the semi-liquid structures, and I believe Carlyle is in that space as well. Can you just walk us a little bit through that? Yeah.
Sure. And part of why we're able to offer private credit in these semi-liquid structures is we talked about this, is the shorter terms of the loans and also the income component of the loans, where you're not necessarily locking up capital for 7 to 10 years without any activity, but there really is ongoing activity across the portfolio when it comes to income, and also when we think of certain elements of fringes of the private credit market that tend to see some activity. So it's certainly it's not a fully liquid vehicle, but there is an element of some liquidity, and it typically allows investors to get in as well as to get out in order to meet their near-term liquidity needs. But it's something that over time does have some liquidity constraints, but not to the extent that one would see in a traditional closed-end fund or a traditional private equity fund.
Yeah, we have a question on what platform or instruments are available for retail investors to provide credit to reliable borrowers. I think after what Vishal has shared with us, it's pretty clear that you need to rely on kind of a middleman, the likes of Carlyle and other private credit managers that you trust in order to access those deals. Those deals are generally really complicated, and extensive due diligence is required in the negotiation process and in the structuring process. So guys like Carlyle, do a really good job in this. And if you are thinking about kind of accessing these pool of borrowers, yeah, I think the best way really is to go through, and probably it's the available way, the only available way. Like you can't really access those companies yourself, right? So it's to go through a middleman, go through a fund manager. I have two more questions for you, Vishal, and one is actually on ESG.
Sure.
Someone is mentioning, what's your view on whether private credit is participating in impact investing? I know it's a space that private equity, venture capital is probably not private equity, has kind of tapped into quite early on. Is there a role for private credit investors in this space as well?
Yeah, it's a good question. Certainly as a lender, there is less flexibility and there is, less influence versus say the private equity sponsor or the borrower itself to affect change. But there are certain ways in which, Carlyle as a lender, as a private credit lender, can incentivize certain borrowers, whether it's, one, there's, the simple way of exclusions and, not investing with certain companies or investing in certain sectors that we deem, are against our ESG values. It does have an effect of making capital for those sectors more expensive because, the supply tends to come down. But there's also, working with borrowers constructively to maybe help them transition to cleaner, business practices. And there's ways to do that. You could potentially offer discounts on the coupon. You could offer other types of resources, Carlyle's broader resources to help them and make introductions really to portfolio companies and the management in order to make some of these changes. So I would say it's more of a soft impact, and it's more about incentives versus really being able to order the change as you would see with PE. But we typically try and align ourselves, the best we can. One is with the companies we invest in, but also companies that we invest in, if they're interested in making that transition, making sure they have the resources to do so.
Yeah. And maybe just to add on my 2 cents here as well, while it might be still, I guess, a little bit challenging for big private credit providers to offer high impact loans to companies, there's another segment. I would also classify it under private credit because it's not publicly traded, and that's microfinance. And we have seen microfinancing funds, it's closed-ended, so it's locked up. And these are the loans provided by specialized companies to, developing countries, SMEs, for them to grow their business. So there is a space for that, but it's probably still a little bit niche, and it caters to very specific interests, and it has varying risk and return profile as well, depending on the profile of underlying loans. Yeah. Maybe just to end off, you don't have to answer this question. I know it's a little bit sensitive, but someone asked a question, besides Carlyle, who else do you most admire in the private credit space? Some names were mentioned, but I will not mention the name. And you have anything to, or you can say my company does not allow me to say this, to comment on other companies.
Well, I will say more generally, without naming anyone,
Sure.
It's certainly a space where a lot of managers have taken interest, including, Carlyle as well. But, at Carlyle, we've really been active here for more than 10 years. I think today you see a number of newer participants in the market as well. But there's really very few managers, I would say, that have the integrated capabilities of Carlyle. When we think of our PE business, our investment solutions business, and our global credit business, there's maybe 6 or 7 managers out there who really have that entire business and who can bring all those capabilities to each investment they do. And we think that's a big differentiator because you get a lot more network benefits. There's a lot more perspective. There's a lot more portfolio intelligence that we're able to leverage that you don't typically see in other managers. So it is, again, no names, but it's certainly a trend in private credit. Other managers have taken attention of that as well. But I think getting it right and getting it right consistently is certainly not an easy task, but hopefully something that, we've tried to do for the last 10 years and something that we're going to try and something we're going to try and keep doing going forward.
That's great to hear. Yeah, I think it's really good for us as fund selectors and as allocators to see a dedication of a manager to the asset class that they manage. And maybe I will provide my perspective on this question as well, because we are agnostic to fund managers, right? We pick fund managers, pick their products that we think will be the best in class in that space and for our clients. So I think when you look at different private credit managers, they also have different styles and different kinds of strategies that they offer. So really the key thing is to do sufficient due diligence on the managers themselves to see where their heritage is, what is their strength and weaknesses. Not every manager is perfect, and to see whether actually their products in different space can complement each other. I mean, private credit is such a big space, and Carlyle might be really good at allocating to different subsegments of asset class tactically through cycles and generating alpha from that. Another manager might be really good at picking up distressed assets and turning it around. Another one might be really good at just doing music royalties, right? And you can put them all together and it will be a diversified portfolio for you. But anyway, I think here today, just wanted to really thank you, Vishal, for spending your time with us at very late time of your day. And yeah, we hope you really enjoy the session. Yeah, do you have any last words for the audience before I let you go?
No, I mean, hopefully that was helpful. And I think hopefully we were able to illustrate just what this asset class is about and hopefully clear some misconceptions as well. And, thank you again for the time.
Yeah, thank you all so much. If you have any questions that we couldn't answer during this session, please feel free to reach out to our advisor. You can find their contact details, I think, in the YouTube link and also on our website. And just a plug-in for the next webinar that we will have, and it will be next Tuesday evening, and it will be on the topic of passive income with 2 other fund managers in the webinar. So thank you so much, everyone, for joining us today, and we wish you a very good afternoon.